Hello everyone, welcome to Commerce classes. Today we will be understanding the last method of calculation of purchase consideration, that is intrinsic value based swap ratio method. Now the name includes two things. Number one is that it is a swap ratio method. That means that against the shares in one company which is going to be liquidated, that is the selling company, the shareholders will get shares in the purchasing company on the basis of some swap. Swap is that you are holding certain number of shares in one company and you will get accordingly proportionate shares in the other company. So it is the swap ratio according to which the purchase consideration will be determined. But how will we determine this swap ratio? This swap ratio is based on intrinsic value. So we first need to calculate intrinsic value of the shares, and then on the basis of the intrinsic value, swap ratio is decided. So in the very second method, we had studied the net payment method, wherein one of the methods was direct method, the second one was swap ratio method. So we were given the swap ratio and accordingly we measured purchase consideration. But in this case, we need to determine that ratio. So you can say that it is a kind of extension to that method. That is that we will be using swap ratio to determine purchase consideration, but we need to determine that swap ratio through intrinsic value of the shares. So let us first see what is meant by intrinsic value of the shares. So intrinsic value of the shares is actually the value of the shares based on net worth of the company. That is the worth of the company when spread over all the shares proportionately, then it is called intrinsic value of the shares. So it can be the net assets spread over the equity shares. Now this method is relevant only for equity shareholders. For preference shareholders, since they are not having any right over the company's residual profits as such, so for them swap ratio concept is not measured actually. It is pre-decided. I mean at the negotiation table, the purchasing company and the selling company, they decide the swap between the preference shareholders. So this we will be using only for equity shareholders. Preference shareholders claim will be decided in some other manner. So let us take up the first step, that is intrinsic value. So step 1 is to determine intrinsic value of the shares of both the companies concerned. That means the purchasing company as well as the selling company. So let us say that one is company X, another is company Y. So for the time being, we are not saying which one is the buying or selling company. Just take the case of two companies. So swap ratio is based on intrinsic value, and intrinsic value is net assets spread over the equity shares. So step 1 is calculation of intrinsic value of the shares. Right. So we will first be taking up all assets of the companies, and when we say all assets, it means all fixed assets, all current assets and investments. So all type of assets will be taken up. However, it doesn't include fictitious assets. So excluding fictitious assets. So leave aside fictitious assets, rest of the assets will be taken up here. Now while recording the assets, these are taken. So you will be taking all the assets one by one. Now these are taken at agreed value, that is their market value, or the book value. If market value is not given, then we take a book value. But while taking the book value, we must remember for all the tangible assets, book values are considered, but intangibles are taken to be valueless if their value is not given. So be it patents or copyrights, we will not consider their value unless and until it is clearly mentioned. But goodwill, yes, goodwill is the part of this because it is a created goodwill, so it does have some value for the company. Now out of the total assets that you have taken, deduct all external liabilities. So it can be long-term liabilities like debentures. It can be current liabilities like creditors, bills payables, or provisions for taxes, or any kind of third party liabilities towards the employees like provident funds, compensation claims, etc. So all liabilities will be subtracted therefrom. Now when we are writing this, we can write up liabilities in the inner column also, and then we can take up the total, or you can write the liabilities one by one here itself. So for the liabilities also, there the final claim will be written. So if creditors are willing to give you 5% discount, so we will be taking up creditors at the reduced value. If the debentures are to be paid at say 10% premium, then that amount will be added here. So we are to take the liabilities at their final claim value. So this gives us the net assets. Right? After calculation of net assets, we are to calculate the worth of shareholders for both equity and preference, so that intrinsic value of equity shares can be measured. Now here we have a few cases to determine the intrinsic value. Case 1 is when company has equity share capital only. Now, if the company is having only equity share capital, it means the whole of the net assets belong to equity shareholders. So, we can calculate intrinsic value per share easily with the formula net asset upon number of equity shares. So take up net assets divided with the number of shares, that will be giving us intrinsic value per share for both the companies. Now second case is when company has both equity and preference share capital. So the company is having both type of capital, both equity and preference. It will imply that these assets belong to both. Now how much will be the share of preference shareholders in this? Now preference shareholders can be of two types, participating and non-participating. When nothing is given, it means preference shareholders are non-participating in nature. It will imply that they have their claim equal to their capital plus any premium payable on redemption, if there is any. So their claim in that case is limited and they are not having any share in the remaining assets available with the company. So we can say the second case is when company has both equity and preference shareholders, but preference share capital is non-participating. So what will happen? You have the net worth with you that you have calculated above. Now out of this worth, you are to give to the preference shareholders their claim. Preference shareholders claim, which is equal to their capital plus if any premium payable on redemption is given. So their capital plus premium will be recorded. Once you pay this, now you are left with the net assets for equity shareholders. So these are your assets for equity shareholders. Right? So now again the formula is same. Since these are the assets available for equity shareholders, take up the number of equity shares from the problem and calculate intrinsic value per share, which is equal to net assets upon number of equity shares. So in any case, in order to calculate intrinsic value per share, we want to have net assets for equity and divide it with the number of shares. So if this is 1 and this is 2, then 1 divided by 2 will give you value per share. So value per share can be determined like this. However, if our company is having both equity and preference shares, this is a bit delicate case when the company is having both equity and preference shares which are participating in nature. Participating preference shares are those which have a right to participate in the residue. It means in the net assets that you have already calculated, once you pay to the preference shareholders their capital, then equity shareholders have a right to get their capital. So you pay to the equity shareholders or you deduct their capital. Now the residual amount, residual surplus is now available for both equity and preference, because your preference shares are also participating in nature as is given. This is the third case. It means this whole residual doesn't belong to equity only. Preference shareholders also have a right over this. So what we shall be calculating is preference shareholders claim on residual. So we'll be provided with the nature of participation. They might be having a right to participate in say 20% of this residual or 1/5 of or 1/10 of this residual. So this we will be calculating as per the terms. Now we'll be getting residual available to equity shareholders. So how much is available to equity shareholders? This is the surplus in total. Out of this, if we deduct preference shareholders claim, so this will be residual available to equity shareholders, A minus B. So this minus preference shareholders claim. So what is the total equity shareholders funds? So now equity shareholders total funds will be equal to their capital plus their residual, right? So their capital is that we have written here, and this is their residual available for them. This is C. So if we add this residual with the equity capital, this is equity shareholders funds. So this will be calculated for both the companies. Now take up the number of equity shares as given in the problem and divide the equity shareholders funds with the number of shares. So intrinsic value per share will be equity shareholders funds upon number of equity shares. So this will be calculated for both the companies separately. So just remember, once we have calculated net assets, we have three cases. When there is only equity capital, the whole amount belongs to equity shareholders. So intrinsic value will be net assets upon equity shares in number. When we have both equity and preference, then preference shareholders are to be paid first because they have preferential right. So out of the net assets that we have calculated, we need to pay to the preference shareholders their claim. So remaining amount is available to equity shareholders. Divided with the number of shares, we will get net assets for equity shareholders. However, the third case is when your preference shares are participating in nature, which implies that they will also be having a right over the residual amount. So the amount which is left after paying preference shareholders doesn't belong to equity only. So they will be paid their capital first, then the residual will be calculated. This is total assets minus preference and equity capital. So the preference shareholders have a claim on this, right? So their claim will be calculated. Remaining is available to equity shareholders. So equity shareholders funds will be equal to their capital plus their residual. So number of equity shares is this much. Intrinsic value per share will be amount available to equity shareholders, that is their capital, their residual upon number of equity shares. So this is how intrinsic value is calculated. Once intrinsic value is calculated, our next step is calculation of swap ratio. But before we do that, let us take up the problem. because we'll take up the problem alongside so that we can understand the calculations easily. Now, take up this problem. We are given the balance sheet of Priya and Nidhi Limited. Their capitals, reserve, liabilities are given, assets are given. Priya Limited is to take over Nidhi Limited on the basis of intrinsic value, and for that purpose assets are revalued and calculate purchase consideration based on intrinsic value. This is case 1 that we are doing right now. So our first step is calculation of intrinsic value. Right. So in the calculation of intrinsic value, we will be taking amounts of Priya Limited and Nidhi Limited. So starting with the assets, all assets except fictitious assets. So we have tangible fixed assets, we have intangible fixed assets which include patents, then we have current assets, and we have non-current investments. Now it says that the patents are valueless, so these are valueless. Investments at 20% less, investments at 20% less, and tangible assets of Nidhi Limited are 1,50,000. This is 1,50,000. Tangible assets 15,000 less for Nidhi Limited, and this was for the Priya Limited. So 15,000 here less, this is 1,50,000. So just make it 1,50,000. This is 15,000 less. This is also 20% less, nothing except this. So take up the tangible fixed assets. Now for Priya Limited it is 4 lakh. This is 1,50,000. Intangibles are we having nothing because these are valueless. Non-current investments 2,50,000 less 20%. So 20% of this will be 50,000, 2 lakh. Current assets are 3 lakh and 1 lakh. So our total assets are 9 lakh and 2,50,000. Now deduct all liabilities. So all liabilities are to be taken at their exact claims, but we are not given anything. It means the book value will be taken. 10% debentures 1,75,000, creditors bills payable, so 1,50,000, 25,000, 20,000. So deduct these amounts. What do we get here? 1,80,000 for Nidhi Limited and 6 lakh for Priya Limited. These are the net assets or net worth. Now in order to calculate intrinsic value per share, we have 3 cases, right? Number 1 is only equity, number 2 non-participating preference shares, number 3 participating preference shares. Now in this problem we are just having equity shares, preference are not given. So very first case, number of shares here is 20,000 and 9,000. So we'll be having number of shares. Herein we have 20,000, herein we have 9,000. So intrinsic value per share, which is equal to net assets upon number of shares. So it is 30 rupees and it is 20 rupees. Now calculation of intrinsic value is done. Now our second step will be determination of swap ratio. Now in a given question, it is very important to read the swap ratio correctly and value this also correctly. Both the factors are important. Measurement of the ratio and reading of the ratio. So how will we measure it? Just write down the second step. Determine the swap ratio. So we start with the company X and company Y and we know their intrinsic value per share. Now whatever is the value that we have determined or given, swap ratio is based on the equivalence factor. Equivalence factor means that we are to multiply the intrinsic values in such a manner that the overall value of the shares becomes equal. So we are to multiply this with something in such a manner that the total value becomes equal, because we are to swap the shares. Swapping is possible only when the two things are same. Like you want to swap one product with the other, they can be swapped only when their value is same. So since the values might be different, so we are to take up an equivalence factor. Multiply the amounts with something that the total value becomes equal. So this we can understand, say this is A and B, in such a manner that this product becomes equal. Now this A and B is referred as the swap ratio. We read this as the swap ratio. Now see it here. Now this is the intrinsic value per share. So what will be the equivalence factor? Equivalence factor is something which we multiply these two with these two, then the total value will become same. So what should be done? What should be multiplied with these two? Different for both. Obviously then there is a swap. So by our common sense we know if we multiply this with 2 and this with 3, it will become 60. Right? So the worth will be 60 and 60. This is the value of one share. It means if you multiply this with 2, that means if we take 2 shares of this company, it will be giving the value equal to 3 shares of Nidhi Limited. So this is equivalence factor. So how do we read it? 2 shares in Priya Limited is equal to 3 shares in Nidhi Limited. Right? So this is the equivalence factor. Now from this we will make out the swap ratio. Now swap ratio will be that how many shares will you be getting in the new company for every share, or for the number of shares held in the existing company. So how do we read swap ratio? Swap ratio is that what will you be getting. When we say swap this thing for another, then our concern is what will I be getting. So swap ratio is the number of shares in purchasing company that you will be getting for the number of shares in the vendor company, in the existing company. So when we are to read it, it can be 2 by 3, it can be 3 by 2. But in a given question, what will we be taking? It will depend upon what is to be done. So our question said that Priya Limited decides to take over Nidhi Limited. Right? So Nidhi Limited is being purchased. So in the Nidhi Limited, that is your existing company. So the shareholders of this company are going to get shares in Priya Limited. So this is the vendor company. You have shares in the vendor company, and now with the process of amalgamation, you will be losing these shares because this company will be wound up and you will get shares in the new company, in the purchasing company, that is 2 shares. So when Nidhi Limited is to be sold or it is taken over by Priya company, so in the new company you will be getting 2 shares for every 3 shares held. So you will be getting 2 shares for every 3 shares held. This is how we read swap ratio. So 2 shares in the purchasing company for every 3 shares in the existing company. This is our swap ratio based on equivalence factor. So once we have decided, then purchase consideration can be calculated easily. Now how do we calculate purchase consideration? Our step 3rd is calculation of purchase consideration. So it is number of shares. This is for equity shareholders, right? Because we work for the equity shareholders in this case. So number of shares in existing company. These are the shares that you are having in the existing company. Multiply this with the swap ratio. This will give you the shares that you will be getting in new company. So equity shareholders will be getting these many shares in the purchasing company. Now at what price will you be getting the shares? So you will be getting at the rate of either intrinsic value of new company, purchasing company, or at the par value. This will depend upon the terms. So if the term is silent, then since we are working for intrinsic value, so shares will be offered at intrinsic value. But if your question says that we will calculate purchase consideration on the basis of swap ratio, but the shares will be issued at par, in that case we will be taking shares at par. So for equity shareholders, they will be getting shares in the new company, which is calculated like this at this price, plus they will be getting cash if we get any. Now how do we get cash in this case? Since in this case a clear cut swap is there, so in this case we won't be having cash, but there can be some cases wherein the cash will be involved. We'll take up that later on, but right now you can say that equity shareholders will be getting shares as per the swap ratio, plus they will get cash. Then for preference shareholders, then according to the terms, their shares will also be paid off, so they will also be getting either shares in the purchasing company, but their terms will not be based on swap ratio at the issue price. Their terms will be separate. So separately their information will be provided, or they might be paid in cash also. So and or cash. So this is your purchase consideration, right? So this is how we calculate purchase consideration. So purchase consideration is the consideration in the form of shares or cash given to the shareholders of liquidating or vendor company, and that how many shares will be given will be based on the swap ratio, and swap ratio is the equivalence factor. So like in the present case, so your swap ratio is 2 shares for every 3 held. So the purchase consideration will be to equity shareholders of Nidhi Limited, because Nidhi Limited is going to be dissolved, it is to be wound up. So how many shares will they be getting? Presently Nidhi Limited is having 9,000 shares. Right. So they were having presently 9,000 shares. As per swap, they will be getting 2 shares for every 3 held. Okay. So these many shares at what price? Now what will be the price at which you will be getting shares? Since you are getting shares in which company you are getting shares? You are getting shares in Priya Limited. So Priya Limited has a price of 30 rupees. So Priya Limited will issue shares at 30 rupees. That means 6,000 shares at the rate of 30, 1,80,000. Since in this case there is no cash coming, so their 1,80,000 is the purchase consideration. We don't have any preference shares also, otherwise they will be dealt with separately. So we will be having this much as purchase consideration. Now question is that if we are asked what will be your answer if shares are to be given at par, that is swap ratio is still there, intrinsic value is involved, but when it comes to give the shares, you will be giving these at par. So we'll still be calculating shares as per the swap ratio, that is 6,000 shares are still being given. The only thing is that in place of 30 rupees they will be given at par. So our purchase consideration will be 6,000 shares at the rate of 10 rupees. So 60,000 will be the purchase consideration if question says give it at par. Now last part is, will your answer be different if Nidhi Limited is to take over Priya Limited? Now the things will be changed here. So when Nidhi Limited is to take over Priya Limited, so Nidhi Limited will continue, Priya Limited will go off. So in Nidhi Limited you will be getting 3 shares for every 2 shares held. You see, your equivalence factor was 2 shares in Priya Limited is equal to 3 shares in Nidhi Limited, right? So now you will be reading the ratio in a different manner. Since this company is to go, this is to be wound up, and the shareholders of this company, Priya Limited, will get shares in Nidhi Limited, which means for every 2 shares held here, they will be getting 3 shares in Nidhi Limited. So now our swap ratio will be how many shares in new company? 3 shares in new company for 2 held. So the shareholders will be calculating purchase consideration as to equity shareholders of Priya Limited. They will be getting 3 shares in Nidhi Limited, that is the shares in the new company, for every 2 shares in their existing company. And in an existing company, they are holding in all 20,000 shares at the rate of, the new company is having 20 rupees per share. So how many shares? 30,000 shares at the rate of 20 rupees. Right? So you will be getting 6 lakh rupees of purchase consideration. Okay. So this is how the purchase consideration is determined. Right. So what we are supposed to do is that in the calculation of purchase consideration, again remember, we are to first calculate intrinsic value. Then we are to determine the swap ratio, which is based on equivalence factor. We are to equate the value, because when a company's shares are converted into shares of another company, the shareholders should not lose the value. So the ratio must be decided in such a manner that the value that they have in the present company becomes equal to the value that they get in the new company. So the equivalence factor, something which is to be multiplied here so that the total becomes equal. This is usually the opposite of this ratio of intrinsic value. You can easily find out. I mean, rather than doing trial and error, just take intrinsic value, take its ratio and reverse it. Okay, if it is 200 and 300, then it will be 3 and 2. If it is 400 and 500, that is ratio is 4:5, take 5:4. So just reverse the ratio and that will give you the total value. So then you need to read it properly. Reading is how many shares in the new company for the shares held in the existing company. These will be given either at intrinsic value or at book value, that is par value, and accordingly purchase consideration will be determined. But for preference shareholders, the consideration will be determined separately. So this is how we calculate purchase consideration. Now coming to this point, cash. As I told you that it can have cash also. Now cash comes here when we are having either a fraction. Like if we are given, say, let's take an example. Suppose intrinsic value of the shares is 30 rupees and 20 rupees as the present case, right? This is A Limited and this is B Limited. Now A Limited is to take over B Limited. Okay, so let us first take up the equivalence factor. The ratio is 3:2, so equivalence factor is 2:3. So 60. Right? So you get 2:3. That is 2 shares in A Limited will be equal to 3 shares in B Limited. Now A Limited is to take over B Limited, which means this company is to move out. So for every 3 shares in this company, you will get 2 shares in A Limited. So your swap ratio is, when we read this ratio, it will be 2 shares in the purchasing company. This is the purchasing company for every 3 shares in the selling company, vendor company. Now suppose B Limited has share capital of 1 lakh shares of 10 rupees each. Okay. So what will be the purchase consideration? Now if I am to calculate purchase consideration on the basis of this swap ratio, I know that the ratio is 2/3. So the shareholders of B Limited will get 1 lakh into 2/3 shares at the value of 30 rupees. Right? Because A Limited is having 30 rupees as the intrinsic value. So how many shares do we get? Now if we multiply this, we will be getting 60,660.66666. But we cannot offer 0.6666 shares. So it will imply it will be equal to 66,666 shares at the rate of 30 rupees. That is, it will be, you can say, right. Now we are left with 2/3 share. and for 2/3 share cash will be given at the same value. So this is 20 rupees. So the total purchase consideration will be 20 lakh rupees. So this is how the purchase consideration may include cash when we are having fraction in the calculations. So cash may be there in the purchase consideration because of swap ratio. There is another way wherein the cash may enter into the calculations. Let us take another example wherein we will be having cash. Suppose intrinsic value is for X limited 41, for Y limited 20. Now, if we are to calculate swap ratio, now based on the equivalence factor, the ratio is going to be very weird. The ratio is 41:20 and the swap will be for 20 shares in this company, you will get 41 shares or the other way around. So what we do is that we just get rid of this extra part. How do we do? We just leave it and then we think that what is the best feasible ratio, which is easy to apply. So if I leave 1 rupee, I will be getting a feasible ratio. So I just take it as 1:2. So it is 41 and 40. So what is the equivalence here? The equivalence here is that if against 1 share in X limited, the person is to get 2 shares in the other company and 1 rupee will be compensated through the cash, right? So this may also include the cash component. So if say Y limited is to take over X limited. Now the shareholders of X limited are having a worth of 41 rupees in 1 share. But when they get shares in Y limited, they will get 2 shares. So our swap will be 2 shares in Y limited and cash of 1 rupee. Because with 2 shares, they will get only 40 rupees of the amount. 1 rupee is still there. So they will get 2 shares in Y limited plus a cash of 1 rupee for every share in the X limited. So if X limited is having say 50,000 shares, so purchase consideration will be for 50,000 shares in X limited, you will get 2 shares in Y limited for every single share in X limited. So for every single share, you will get 2 shares at the price of 20 because Y limited will be offering shares at their own price. So 1 lakh shares at 20 and this 1 rupee of difference will be compensated in form of cash. So a cash of 1 rupee for every share in the company. So 50,000 rupees of cash. So 20 lakh 50,000 rupees will be the amount of purchase consideration. Right. So I hope you have understood that purchase consideration based on swap ratio is that first of all we are to calculate the intrinsic value. Now once we have calculated net assets, we have 3 cases. When there is only equity capital, the whole amount belongs to equity shareholders. So intrinsic value will be net assets upon equity shares in number. When we have both equity and preference, then preference shareholders are to be paid first because they have preferential right. So out of the net assets that we have calculated, we need to pay to the preference shareholders their claim. So remaining amount is available to equity shareholders. Divided with the number of shares, we will get net assets for equity shareholders. However, the third case is when your preference shares are participating in nature, which implies that they will also be having a right over the residual amount. So the amount which is left after paying preference shareholders doesn't belong to equity only. So they will be paid their capital first, then the residual will be calculated. This is total assets minus preference and equity capital. So the preference shareholders have a claim on this, right? So their claim will be calculated. Remaining is available to equity shareholders. So equity shareholders funds will be equal to their capital plus their residual. So number of equity shares is this much. Intrinsic value per share will be amount available to equity shareholders, that is their capital, their residual, upon number of equity shares. So this is how intrinsic value is calculated. Once intrinsic value is calculated, our next step is calculation of swap ratio. But equivalence factor. And what this equivalence factor is? It is the intrinsic value ratio in reverse order. So that the multiplication, if you multiply the two, the amount becomes equal. So this swap ratio will be calculated. Then this is to be read properly, and in order to read it properly, we will be reading it. How many shares in the new company for these many shares in the old company. So the shares in the new company that you are to get will be the numerator, and denominator will be the shares in the existing company. So in this case, A and B, this is our swap ratio. So if A company is to be sold off, if X company is to be sold off, the ratio is B by A. And if Y is to be sold off, then for every share here, you will be getting these many shares. So it will be A by B. So numerator is what is to be continued. So the company which is to be continued, their factor will be the numerator. After that, purchase consideration will be calculated. But in the calculation of purchase consideration, we may get cash also. Cash is when the calculation is not complete, when we are getting the fractions. So the cash will be calculated. Or in case our intrinsic values are coming in such a manner that we are not able to calculate easy swap ratio, when there is a marginal difference. So that difference will be settled through cash, and remaining amount will be settled through the swap ratio. So if we just leave this 1 rupee, our ratio is very easy to handle. 1 share for 2 held or 2 shares for 1 held. So we just leave aside 1, that 1 will be settled in cash. You have a worth of 41 rupees, you get 40 through shares and 1 through the cash. So this is how swap ratio works. Now you can practice some questions on the calculation of purchase consideration from your books. Next time we'll be either taking up one more example of this swap ratio, or we can directly start with the accounting part. Thank you.